Welcome to Talk Tickers, your deep dive into the most important earnings calls. Today we're dissecting the Andersons, that's ANDE, their Q2 2025 performance, and what their strategic roadmap looks like going forward. We've looked at the call, the numbers, and we're here to help you understand what really matters.
Indeed. We've gone through the latest call pretty meticulously, and while the headline numbers might seem a bit mixed at first glance, there are some really compelling strategic moves and forward-looking comments that definitely caught our attention. This isn't just about the past quarter. It's about seeing where they're positioning themselves for the future.
Absolutely. I mean, this is a company right at that intersection of agribusiness and renewables. It's fascinating. They're dealing with dynamic commodity markets, obviously, but also making these significant long-term bets. So let's get into it and unpack the essential insights for you. Okay, let's get straight to the numbers for Q2 2025. The Andersons reported GAAP EPS of $0.23, and their adjusted EPS, that non-GAAP number we often look at for core profitability, came in at $0.24. Both of those significantly missed the consensus estimates, which were around $0.51. That's quite a miss on the bottom line.
Yeah, definitely raised some eyebrows. But it wasn't all bad news. Revenue actually came in quite strong, $3.136 billion.
Yeah.
That comfortably beat the consensus estimate of around $2.86 billion. And it's a pretty robust 12.2% increase year over year.
Yeah.
So they were definitely moving product. Top line looked good.
Right, strong top line. But then adjusted EBITDA earnings before interest, taxes, depreciation, amortization that saw a decline, dropped 33% year over year, down to $65.2 million from $98 million in Q2 last year. Now, here's where it gets interesting for you, the listener. Despite this mixed picture revenue beat, profit miss then, the market reaction was intriguing. The stock actually rallied intraday on the day of the call.
Yeah, that intraday rally is really a critical signal, I think. It strongly suggests investors were looking past the immediate numbers and focusing more on the strategic story the company was telling, which sort of points to this balance where the strategy and the forward guidance really shaped how people felt, maybe easing concerns about that profit miss.
Okay, let's unpack that more. Let's dive into the segments, because overall EBITDA being down doesn't tell the whole story, right? In agribusiness, their adjusted pre-tax income fell quite a bit, $16.8 million this year versus $32.6 million last year. And renewables also saw its pre-tax income attributable to the company drop. That was $10 million, down from $23.0 million. So yeah, headwinds in both areas.
Right, but the reasons why are quite different, and that's what's fascinating. Renewables, for instance, they were dealing with softer ethanol board crush margins. That's, the core profitability of turning corn into ethanol. Plus, they had higher corn bases, the local price difference making their main input, corn, more expensive. And this was despite their plants running pretty efficiently, they said.
Oh, and also lower feed values, partly because there was just a lot of soybean meal around. That also kind of squeezed the margins on their co-products.
So yeah, a tough environment for the ethanol side, but within agribusiness itself, it sounds like a kind of a tale of two halves, because their nutrients business actually did well, benefited from higher U.S. corn acres. Exactly. More corn planted means more demand for nutrients. So that part of agribusiness saw higher volumes and margins, which was a positive. But that good news was offset by their merchandising business. That part really struggled. They were facing this grain oversupply, especially out west, and demand wasn't strong there either.
Yeah.
So end users, the buyers, were just making very short-term purchasing decisions. Hard to lock in good deals for Andersons.
Right. Which leads to the big question. What's management actually doing about these challenges? Are they just writing it out?
No, they seem pretty proactive, actually. They talked about optimizing the portfolio. They mentioned exiting a few underperforming businesses and some minority investments. Had about a $7 million impact in adjustments. Things like selling an Idaho facility, closing some fertilizer contract manufacturing. It shows you they're willing to cut things that aren't working to focus resources.
Okay, and that focus leads us to the really big news, the major strategic move they made. This feels quite significant. They completed the acquisition of the remaining 49.9% stake in the Andersons Marathon Holdings TAMH. That closed July 31st, cost $425 million or $385 million net after working capital adjustments. This gives them full 100% ownership of 4 big ethanol plants. We're talking about 500 million gallons per year capacity. That's a huge step.
It's absolutely pivotal, a transformative transaction, I'd say. And it's about more than just the immediate numbers. Management expects it to add to EPS right away, which is good. But the key thing is, while their EBITDA already reflected 100% of TAMH, now 100% of the earnings, and critically, the cash flow comes directly to Anderson shareholders. They're projecting an extra 70 cents to 75 cents per share annually from this, maybe even over $1 in good years.
So more money flowing directly to them. But what else does full ownership unlock strategically? Does it change how they operate?
Oh, definitely. Think about it. Full ownership means full control. No more partner constraints. They can fully integrate these plants into their broader renewable strategy, maybe explore new co-products, optimize supply chains more effectively. It just simplifies decision-making, gives them way more flexibility in how they deploy capital. And importantly, there's minimal integration risk because they've been operating these plants for years. It's about unlocking value they already managed.
Makes sense. And beyond just owning the plants, they're looking at ways to make them, well, greener and more valuable, right? Carbon capture. They filed for a Class 6 well permit. That's for a potential carbon sequestration project at their plant in Clymers, Indiana. And for you listening, a Class 6 well is specifically for injecting CO2 deep underground for permanent storage. That's a big deal for accessing tax credits.
Exactly. And this isn't just, some far-off possibility. They expect all 4 of their ethanol plants will start generating 45Z tax credits within the next year. The 45Z credit from the Inflation Reduction Act is a huge incentive for clean fuel production based on reducing greenhouse gas emissions. That's a massive regulatory tailwind that could seriously boost the profitability of that renewable segment, makes those assets much more valuable.
Okay, so if we connect all these dots, the TAMH buyout, the carbon capture focus, the tax credits, it really looks like a deliberate strategic shift, doesn't it? Moving away from just being exposed to commodity cycles in merchandising towards a more vertically integrated model focused on renewables alongside their core ag business.
That's exactly how I see it. They're trying to build a more resilient business, maybe less volatile. They'll always have some ag cycle exposure, sure, but the emphasis seems to be shifting towards leveraging these renewable assets for potentially more stable, predictable, and frankly, government-incentivized revenue streams. Better earnings quality, perhaps?
And management sounds cautiously optimistic about the second half of this year, 2025. They mentioned seeing ethanol crush margins pick up already in July, expecting more improvement through the summer. That helps renewables. And they're also anticipating a big fall harvest, which, okay, can pressure prices, but for them, it means big opportunities for merchandising and storage with their U.S. grain assets into 2026.
Right. And their capital spending plans really back up this long-term vision. They're continuing work on 2 major multi-year projects. One is upgrading their Port of Houston grain facility, expanding it specifically for soybean meal export. That's a key logistics hub. The other is a project for a major energy company, they said. Both are slated for completion around mid-2026 and should start contributing financially then. So they're investing for the future, not just managing the present.
And that Houston project for soybean meal, management had an interesting point there. They said even though soybean meal prices have dropped recently, the flat price isn't really the main driver for that investment. It's more about the fact that the U.S. is likely going to produce way more soybean meal than we use domestically. That surplus has to go somewhere, right? It'll likely push prices towards export parity, which makes their expanded Houston export facilities super competitive and essential for moving that extra meal globally. It's a smart angle for you to consider.
Very insightful point. And all this strategic maneuvering leads to a shift in how they're talking about their financial goals. They've converted their old run rate EBITDA target that was $475 million by 2026 into an EPS target. Now they're aiming for approximately $4.30 per share by the end of 2026. That EPS target, it better captures the full earnings impact, including those potential tax credits from TAMH. It's a clearer measure of shareholder value, really. Shows confidence.
Okay, so summing up the key things for you, the listener, to watch going forward, definitely the smooth integration of TAMH, that seems low risk. The path of ethanol margins, that's critical. Progress on the carbon capture projects, especially that Clymers well permit, and getting those 35Z credits flowing across all 4 plants. And then mark your calendars for their Investor Day, December 9th, 2025 in New York City. They promised updates on their multi-year roadmap there.
After digging into all this, the numbers, the strategy, my mind is kind of buzzing with how this might play out in the market. So let's shift to our This Is Not Financial Advice segment. If I had to pitch an idea, maybe a bit outrageous but plausible based on this call, here's what I'd suggest. I'd propose going long the Andersons but pairing it selectively. My thinking is the market might still be overly focused on that Q2 EPS miss, even with the intraday rally they had. I have a hunch the market is seriously underestimating the combined punch of getting 100% of TAMH's earnings, plus the impact of those 45Z tax credits hitting all 4 plants soon. We know the credits are expected within a year. The Climber CCS permit is filed.
If TMH accretion and the 45Z benefits really kick in, like they could, I think Anderson's could absolutely hit, maybe even beat that $4.30 EPS target for 2026.
Yeah.
And potentially with better, more stable margins than people expect right now.
That's definitely an interesting thesis. Betting on the market, catching up to the full potential of this strategic shift. What would you watch to confirm that thesis is playing out? And what's the other side of the pair trade? The hedge.
Good question. To validate, I'd watch management's updates on the 45Z timeline, any news on the Climber CCS project, and obviously how those ethanol margins track in the near term. For the pair trade, to isolate the Anderson-specific strategy and hedge against general ag volatility, I'd short a pure play, probably smaller regional grain merchandiser, specifically one heavily exposed to that weaker Western grain belt, and crucially, one without a clear renewables diversification plan or major infrastructure upgrades like Anderson's has.
So you're betting on a fundamental split in business models. Anderson's, with its focus on light processing, storage, and especially this boosted incentivized renewable segment, versus a more traditional undiversified grain handler stuck in maybe a tougher spot. That contrast really highlights the potential upside from Anderson's strategy, makes it an asymmetric bet, banking on their diversification to outperform. It's a bold take on their story. Definitely a bold idea, and it really captures the essence of what we've discussed here. The Anderson's Q2 was, a mix, some clear challenges, but also these decisive strategic wins. The path forward seems very much focused on leveraging that bigger renewables platform and optimizing the core ag business for higher value.
Indeed. It felt like the market initially reacted to the miss, but then maybe started appreciating the long game. Moves like the TAMH buyout, pursuing carbon capture, these seem to have resonated with investors looking beyond just the next quarter. You're really watching a company trying to position itself for growth in what's clearly a changing landscape for both agriculture and energy, capitalizing on tradition and new green trends.
Absolutely. And as always, please remember this discussion is purely for informational purposes. It's not financial advice. Investing always carries risks, so consider your own situation carefully.
We certainly hope this deep dive gave you some valuable, maybe actionable insights into the Anderson's Q2 call, and maybe something for you to think about as we wrap up. In today's world, can a company really reduce its risk by leaning into renewables, or does it just swap one kind of market uncertainty for another? Food for thought. Thanks for tuning in to Talk Tickers. We'll connect with you again soon for our next deep dive.